Professor Nam-Yong Lee's long commentary, Diagnosing Investment Strategies for the AI-based S&P 500 Index Futures Market. Hello, this is Nam-Yong Lee for Lee Nam-Yong Professor TV. Today I would like to calmly examine how Korean investors should view and approach futures trading on the US S&P 500 Index, Standard & Poor's 500 Index, when it is combined with artificial intelligence, AI, artificial intelligence. What opportunities are hidden inside it, what fatal risks are embedded, and finally what core AI techniques are actually being used. I do not see this as a mere trading technique. I see it as a new battlefield that can shake the relationship between our household finances and the entire national financial system. Let me first sketch the playing field. S&P 500 futures are contracts for buying and selling the future value of the S&P 500 index, which is composed of 500 large US companies. These futures are one of the representative core global products traded almost 24 hours a day across the world on the Chicago Mercantile Exchange. According to CME data, E-mini S&P 500 futures, ES, have a daily trading liquidity measured by notional value that is more than about 8 times larger than all of the main S&P 500 exchange-traded funds, ETF, exchange-traded fund, such as SPY, IVV, and VOO combined. As of October 2025, the CME Group's total average daily volume in derivatives is reported to be around 26.3 million contracts. If the cash equity market that we usually access through funds and pension products is the heart of the US stock market, then S&P 500 futures can be seen as the pulse that reveals the rhythm of that heart in real-time prices. On top of this comes leverage, because you can control a large notional amount with a relatively small margin deposit. You can amplify profits in a short time if you are right about market direction, but if you are wrong, you can lose your entire principal and face additional margin calls. It is an inherently high-risk structure. What is now being enthusiastically combined with this market around the world is AI-based S&P 500 futures trading. In fact, attempts to attach AI to S&P 500 futures have been ongoing since the 1990s. In 1998, an academic paper in an international journal presented a hybrid AI system that combined artificial neural networks with rule-based systems to construct a trading strategy for the S&P 500 futures index. Since then, dozens of studies have applied machine learning, ML, machine learning, and deep learning, to predict the direction of the S&P 500 index and its futures. More recently, we have even seen multi-agent deep learning models for S&P 500 futures in which multiple intelligent agents learn on their own which of long, buy, short, sell, or stay out to choose each day. Reports published in 2021 and 2025 by the International Organization of Securities Commissions, IOSCO, International Organization of Securities Commissions, show that global asset managers and broker-dealers are already using AI and ML extensively in algorithmic trading, order execution, risk management, and market making, while warning at the same time that new risks are growing around governance, data quality, and lack of explainability. Seen from the outside, it is easy to fall into the illusion that AI is now better than humans, so we can just hand everything over and let it trade for us. However, when we look a little more deeply into the research results, the reality is far colder. Many studies that use machine learning to predict the next day direction of the S&P 500 index show accuracy levels that hover only slightly above 50%, which is close to a coin toss. In certain periods and under specific market conditions, these models do outperform traditional statistical models, but when the market structure changes or volatility spikes, their performance often collapses. In other words, While AI can certainly be a useful tool in the futures market, it does not automatically become a money-making machine that always wins. IOSCO's reports likewise stress that although AI can bring significant efficiency gains to capital markets, weak internal controls and oversight can cause investor harm and systemic risk to expand at the same time. At this point, let me briefly organize the core AI techniques actually used in S&P 500 futures in a simple way. First is supervised learning. We feed into the model dozens or hundreds of variables such as past prices, trading volumes, volatility, options market data, VIX, open interest in options, exchange rates, interest rates, economic indicators, and even news and social media signals. The model then attempts to predict tomorrow's return or whether prices will rise or fall tomorrow. Techniques such as linear regression, logistic regression, random forest, XGBoost, and structural equation models are widely used. Second is time series deep learning. Because market prices move continuously over time, the model must remember the footprints of many past days and detect patterns. Recurrent neural networks such as long short-term memory, LSTM, long short-term memory, and gated recurrent unit, GRU, gated recurrent unit, as well as more recent transformer architectures specialized for time series, are used to make judgments like, if we see this pattern over the last n days, then tomorrow there is such and such probability of a rise or a fall. Third is reinforcement learning. Here the model chooses actions such as enter long, enter short, close the position, or stay out at each point in time, and at the end of the day, it receives profit or loss as a reward signal and updates its policy. By repeating tens of thousands of simulated trades, it learns which actions are most advantageous in the long run under different market conditions. Fourth is risk management and ensemble. In practice, we do not rely on a single model. Instead, we aggregate the opinions of multiple models, or we impose traditional risk rules such as maximum drawdown limits, position size limits, and volatility-based leverage adjustments on top of AI models to prevent the overall system from running out of control. The core problem is that all of this is trained purely on historical data. No matter how smart AI becomes, events such as the 9/11 terrorist attacks, the global financial crisis, the COVID-19 pandemic, major geopolitical wars, surprise announcements by central banks, or exchange outages can shake the market in ways that differ entirely from the past. In fact, in November 2025, a cooling failure at a data center used by CME Group and other US derivatives markets caused major futures and options trading to be halted for more than 10 hours, paralyzing price discovery and hedging functions for key products such as S&P 500 and Nasdaq 100 futures worldwide. When the technology infrastructure stops, even the most sophisticated AI strategy stops with it. When a liquidity vacuum opens, even small orders can cause violent price swings. Now let us turn to the practical question: how should investors approach this market? For Korean investors considering AI-based S&P 500 futures trading, I would like to recommend a 4-step approach. The first step is to understand futures and leverage themselves completely. You need to know exactly what the notional value of one S&P 500 E-mini and one micro E-mini contract is, what the required initial margin and maintenance margin levels are, how margin calls and forced liquidation mechanisms work, how to roll positions at expiry, and how profits and losses change with each tick of the price. You must work through the numbers yourself. Adding AI on top of this foundation without understanding it is like a novice driver who does not know how a car works, sitting in the driver's seat of a self-driving heavy truck on the highway. The second step is to examine your own financial, psychological, and time structure. S&P 500 futures often make their biggest moves at night and in the early morning in Korean time. I recommend that each person decide for themselves a concrete loss number they can truly tolerate and then limit their participation in this market to no more than 1 to 5% of their total financial assets. The principle is that you must never touch your living expenses, housing funds, retirement savings, or children's education funds. In addition, if your job or family situation does not allow you to monitor the market frequently, then avoiding leveraged futures trading entirely may be a far wiser long-term decision. The third step is to set a clear principle that AI is a servant, not the master. AI's role should be limited to quickly organizing information, detecting patterns, and simulating multiple scenarios. The final decisions on entry, exit, stop loss, and leverage should always be made by the investor. Many people cross the line at this point. They hand over their API keys, link their accounts, and think, the AI will take care of everything for me, in effect, giving up real decision-making authority. At that moment, the investor is no longer the owner of the capital, but becomes a capital provider for the AI system and its operators. The fourth step is to perform a 3-stage validation before committing in size: backtest, paper trading, live trading with very small amounts. Any AI strategy should be backtested over at least 5 years of data that includes bull markets, bear markets, and sideways markets. The key is not only average returns, but also how large the maximum drawdown was and how many consecutive losses occurred. Next, you should run paper trading for several months in an environment that mirrors real-time prices to see whether the strategy remains profitable after accounting for commissions and slippage. Finally, you should trade with a tiny live position size, no more than 1 to 5% of your total assets, and observe whether your own psychology and the system both behave according to plan amid real-world volatility. Even after all this, you must always remember that if the market structure changes, the strategy can fail at any time. There are, of course, clear opportunities in AI-based S&P 500 futures trading. First, as mentioned, S&P 500 futures represent one of the deepest and most liquid markets in the world. By using E-mini and micro E-mini contracts, even relatively small investors can hedge and adjust exposure to an entire portfolio efficiently. Second, because the market is open almost 24 hours a day, it can react faster than ETF markets to geopolitical events, central bank comments, and macroeconomic data releases that occur after the close of the regular US trading session. Third, AI can quickly process massive amounts of data that humans cannot handle, combining information from prices, volumes, options, interest rates, exchange rates, news, and social media to uncover patterns is precisely the kind of task that machines are better suited for than humans. Recent regulatory reports also present numerous cases in which AI improves execution quality, supports liquidity provision, and enhances risk management. However, the risks are even greater. The first is the risk from leverage and volatility. When the index moves sharply, leveraged S&P 500 futures positions can cut an account in half or wipe it out entirely in a very short time. The second is model risk and overfitting risk. As mentioned earlier, most machine learning models that attempt to predict the direction of the S&P 500 barely exceed 50% accuracy, and the more complex the model, the more likely it is to fit past data well while delivering unstable performance in the future. The third is the risk from changes in market structure and tail risk. Wars, pandemics, financial institution failures, and exchange outages hardly appear in backtests, yet they dominate real-world crises. The CME trading system outage I mentioned earlier shows that the stability of the technology infrastructure itself is a major risk factor. The fourth is regulatory and fraud risk. In 2024, the US Commodity Futures Trading Commission, CFTC, Commodity Futures Trading Commission, issued a customer advisory titled, "AI will not turn your trading bot into a money-making machine," warning that scams promising thousands of percent returns and 100% win rates using AI-powered trading bots and signal services are surging. The US Securities and Exchange Commission, SEC, Securities and Exchange Commission, also issued an investor alert on AI-related investment fraud in 2024 and has sanctioned investment advisors for exaggerating or misrepresenting their AI capabilities, highlighting the problem of so-called AI washing. Viewed through the lens of relational philosophy, AI-based S&P 500 futures trading is not merely a relationship between me and the market. It is a single node in a dense network that connects Korean households, US corporations, global capital markets, regulatory bodies, and technology platforms. Excessive leverage and bankruptcy in one household shake that family's consumption, education, and retirement plan. When similar patterns occur simultaneously across tens of thousands of households, the stability of the entire financial system can be threatened. In this network, AI acts as an amplifier that explosively accelerates the flow of information and orders. When the direction is correct, it enhances efficiency and productivity. When the direction is wrong, it accelerates crises and collapse. Therefore, I would like to leave you with one final question. At this moment in time, for my life and for my family, is leveraged AI-based S&P 500 futures trading truly necessary? If your honest answer is, even so, I want to study and cautiously try it with a small portion of my assets, then only at that point do I recommend that you begin to walk through the 4 stages I have outlined, understanding the structure of futures, examining your financial and psychological situation, keeping AI in the role of servant, and conducting backtests, paper trading, and live trading with very small positions. If, on the other hand, this question makes you uneasy, and even after hearing these explanations, you still feel that you do not fully grasp the basic concepts of futures, then I would say that staying out of this market is, in fact, a far greater profit for you. Artificial intelligence is a gigantic tool of our era. Whether that tool becomes a weapon that destroys our household finances or a powerful teacher that raises our level of financial literacy ultimately depends on the network of relationships in which we use it, for whose benefit we deploy it, and in what direction we choose to wield it. Lee Nam-yong, Professor TV, will continue to explore together with you the vast relationships among AI and finance, leverage and household economies, and the stability of our overall system. Thank you for watching Professor Nam-yong Lee's long commentary.